Hello guys, this is Senior Hannington once again, your accounting tutor. I hope you're all doing well. In today's video, I'll show you how to prepare the statement of changes in equity. That is our topic today, preparation of the statement of changes in equity. We are going to see what the statement of changes in equity is, and then how do you prepare the statement of changes in equity. So let's get right into our question for today. This is a question from the CPA Financial Accounting question paper, and there we go. Describe the components of a set of financial statements that must be prepared by an entity at the reporting date. There are some 5 marks for you, describing the components of the set of financial statements that must be prepared by an entity at the reporting date. Now, according to IAS 1, presentation of financial statements, a complete set of financial statements comprises of Roman 1, the statement of financial position as at the end of the period. It also comprises of the statement of profit or loss and other comprehensive income for the period. A statement of changes in equity for the period. A statement of cash flows for the period. And then notes comprising material accounting policy information and other explanatory information. Those are the components of a set of financial statements. Remember, a statement of profit or loss and other comprehensive income shows the financial performance of the entity. The statement of financial position shows the net worth of the entity as at the reporting date. The statement of changes in equity shows the movement of the elements of equity, as we are going to see. The statement of cash flows shows the movement of cash and cash equivalents at the reporting date. Then, notes to the accounts. These explain what is on the face of the financial statements and the accounting policies that have been adopted. So those are the components of a set of financial statements that must be prepared by an entity at the reporting date. Part B, the following is an extract of the trial balance from the books of Chivok Traders Limited, KTL, as at 30th November 2014. You have land, the general expenses, you have the buildings, you have inventory, that is 1st December 2013. We have the purchases and sales. You have the ordinary share capital, that is 2,000 per share. You have the general reserves. You have the revaluation reserves, profit or loss 1st December 2013, and then the share premium. We have some additional information, as you can see, but I think I'll come to the additional information. What are we required to do? Prepare a statement of changes in equity as at 30th November 2014 for KTL. That is my statement of changes in equity for KTL as at 30th November 2014. That is already the draft which we have. So you have to come up with that. Now, when it comes to the statement of changes in equity, as I've told you, it shows the movements in the equity items of the entity. When we talk about equity items, here we are looking at the share capital, share premium, general reserves, revaluation reserves, as well as the retained earnings. Those are the equity items. Those are the equity items. So we have share capital. Then we also have these other reserves, the share premium, the general reserves, the revaluation reserves, as well as the retained earnings. In fact, these other reserves can be categorized as capital reserves and revenue reserves. When I talk about capital reserves, here I'm looking at those reserves that are required by law in certain circumstances, and they cannot be paid out as a dividend. And these include the share premium. Remember, share premium, that is the premium on issue of shares. Revaluation reserves. Revaluation reserves, these records any unrealized gain arising on non-current assets revaluation. Then under the revenue reserves, these are created from the profits of the business and they are paid out as dividends. For example, the retained earnings, or what we call the accumulated profits. These are the records of all the retained profits of the company. Then the general reserves is an extension of the retained earnings reserve. So we need to look at the question and see, do we have opening balances as at the start for all these different items we have here in our statement of changes in equity? We have ordinary share capital. There is an opening balance of 200,000. General reserves we have, revaluation reserves we have. Then we also have the profit or loss 1st December 2013, that is your retained earnings, and then the share premium. So the first thing I'll do in my statement of changes in equity, I'll enter these opening balances for our equity items, the share capital, and then the other reserves. So, opening balances. We have our opening balance, so it's what I'll enter first. Share capital. Share capital is how much? Share capital is 200,000. Remember the amount, the level of rounding off is thousands, as you can see up. So share capital is 200 millions, but here I'll put the 200,000. Share premium has been given as 6 millions as at the start. So I'll put 6,000 here. Then the general reserves, 80 millions. That is 80 millions. Then the revaluation reserves, 4 millions. The retained earnings, that is profit or loss at 1st December 2013, we have 48,000. But now, when we look at the 48 millions, this is on the debit column of the trial balance, meaning that these are losses. These are losses. So, I'll enter them in my statement of changes in equity. But it's a loss, as you can see. It's a loss, 48,000. Then of course I can get the total. Can get our total. So I'll sum up. So we have our total as 242 millions. 242 millions. Now, that is the first thing you will do in your statement of changes in equity. Start by entering the opening balances. Start by entering the opening balances as at the start. Opening balance as at 1st December 2013. As at 1st December 2013, that is your opening balance. Now, after showing the opening balance, now we can look at the changes, the movements during the year in all these different items which we have. You expect the company to issue out shares And in this question, we see in the additional information that during the year to 30th November 2014, KTL issued an additional 40,000 ordinary shares at shillings 2,100 per share. So we are going to find out how much were the proceeds from the issue of these shares. Are these shares issued at a premium? Remember, the nominal value of a share is 2,000 as per our trial balance, 2,000 per share. But these shares have been issued out at 2,100 per share. So there is a premium of 100. So let us see the issue of shares. These are my notes here. Notes. Note 1. Issue of shares. They have issued out how many shares? They have issued out 40,000 ordinary shares, each 2,100. Each 2,100. So what are the proceeds from the issue of shares? The proceeds. We get 40,000 shares each at 2,100. If you've issued out 40,000 shares and each share you're issuing it at 2,100, that is how much? That is 84 millions. That is 84 millions. However, your share capital, you have received the 84 millions, but remember the nominal value of each share is 2,000. So share capital increases with the nominal value of the shares that have been issued out. So I'll get the 40,000 shares at how much? At shillings 2,000. And this will give us how much? That is 80 millions. That is share capital. Then the premium on the issue. The premium, that is the profit that was made on the issue of these shares. That is 40,000 shares, but each share, the company makes a premium of 100. And that is the 4 millions. Sometimes they can ask you to show journal entries. So if I'm to show the journal entries, they will debit bank with 84M. Then they will be crediting the share capital with 80 millions. Then we credit share premium with the 4 millions. So take this to your statement of changes in equity. Increase share capital by 80 millions, increase share premium by 4 millions. So issue of shares. Issue of shares. Look at note 1. Share capital has increased by 80 millions. Then our share premium has increased by 4 millions. Total, that is 84. Simple. 84 millions. Now from the issue of shares, of course, during the financial year, the company prepares the statement of profit, loss, and other comprehensive income. That statement of profit or loss and other comprehensive income is prepared to show the financial performance of the business. We have to find out, have they made a profit or they have made a loss? That profit or loss that has been made will affect your retained earnings. Will affect your retained earnings. When you look at the question, the only profit or loss we have is the balance from the previous year, that is at 1st December 2013. So we don't have the profit for the year. We have to come up with a working showing how much profits the company has made during the year. So we have to come up with a simple extract of the statement of profit or loss. A simple extract of the statement of profit or loss. Let us come up with our extract of the statement of profit or loss. Now that is going to be my note 2. That will be note 2. So note 2, we are going to see how we can come up with the statement of profit and loss. You know how to prepare that statement of profit and loss. You get your sales revenue, you less the cost of sales, then you get the gross profit, then from the gross profit you less the operating expenses, then you come up with your net profit for the year. So notes, this is my note 2. We are going to come up with the extract of the statement of profit and loss. Statement of profit and loss. We get sales, the revenue. Revenue was how much as per the information given? Revenue, that is 600,000, because you have purchases and sales. 600,000 is your revenue. Then you move to the cost of sales. You have your opening inventory in the trial balance, that is 46,000. Then you have to add the purchases. How much are the purchases as per the trial balance? That is 400 to 600. Then you will have to less the closing inventory. That is as per the additional information. We have been told that inventory at 30th November 2014 was valued at shillings 24 millions. KTL expects to realize shillings 27.5 million from selling this inventory. KTL values inventory in accordance with the IS2 inventories. Now, according to the IS2 inventories, the measurement rule is very clear. Value your inventories at the lower of cost and the net realizable value. So the lower amount here is the 24 millions, because 24 is compared to 27.5 millions. The lower is 24 millions. That will be the value of your closing inventory, 24 millions. How much is the cost of sales? So we get 46,000 plus 402,600, then minus 24,000. That gives us 400, 24,600, which is deducted from the revenue to come up with our gross profit. Now the gross profit, that is how much? That is 175,400. Then you'll have to less check the operating expenses. Do we have any? You have the General expenses 13,400 less general expenses, $13,400. Do we have any other expense? Any other expense? They have talked about depreciation somewhere, that at 30th November 2014, land and buildings were revalued as follows: land 100 million, then the buildings 295 million. Non-current assets are depreciated 2.5 per annum on reducing balance. The revaluation is at the end of the year, so it will not affect your depreciation figures in the current year. So depreciation on the buildings, that is 300,000. Now, is this cost? We don't know whether this is cost or it's a carrying amount, but assuming that is your carrying amount, then I'll subject it to 2.5. What is 2.5% of the buildings? 300,000. That gives you 7,500. Okay, so let us consider that as our depreciation expense. That is 2.5% of how much? Of 300,000. And that is 7,500. These are the only expenses which you have. Then you get your profit for the year. Which is how much? Let us try to see how much is the profit for the year. Get your calculators. 175,400 minus 13,400 minus 7,500. This is 154,500. That is your profit for the year. That is your profit for the year. Now, this profit for the year will increase your retained earnings. It will increase your retained earnings. So we can take it to the statement of changes in equity in the column of retained earnings. So I'll save profit for the year. Profit for the year. Please, you look at note 2. You get it from note 2. And that is, we have seen we have 154,500. Retained earnings, that's where you take that. 154,500. Don't forget the totals. Oh, sorry, it should be here. It should be here, down 154,500, not here. Date your totals, 154,500. That is your profit for the year. Now, the other thing, when it comes to the statement of changes in equity, you'll see that the company has general reserves. Then at times there will be a transfer to be made from the retained earnings to general reserves. Let us try to look at that. Note 1, KTL transferred shillings 2 million from the profit for the year to the general reserves account. So you have to transfer from your retained earnings column now to the general reserves column. That is a 2 million. Transfer from profits for the year to general reserves. So let's work out that also. Transfers to general reserves. So you're transferring from the retained earnings. You're transferring how much? You're transferring 2 millions. So it's a negative 2 millions. But you're transferring to what? To the general reserves. So we reduce our retained earnings then we increase the general reserves. The net effect of this is a 0, because I'll simply get this 2000 plus a negative 2, giving us a 0. That is transfers to the general reserves. Then the other item in the statement of changes in equity, there can be dividends paid. We have to find out if there are some dividends, the dividend payments. Note 5, a dividend of shillings 210 per share for the year ended 30th November 2014 was declared. We have to come up with the dividends that were declared. Of shillings 210 per share for the year ended 30th November 2014 was declared. Let me show that in working in note 3. Dividends. So dividends paid. They have said 210 per share. $210 per share. But the question is, this company has how many shares? We have to find out how many shares do they have. Okay, how many shares do they have? Because each share they are going to be paying 210. So how many shares do they have? Let's try to find out the shares the company has. We see ordinary share capital, shillings 2,000 per share. But that share capital is 200,000. So if it's 200,000 and each share is 2,000, it means that this company has 100,000. In fact, it is 200 millions. Don't forget the 3 zeros up. 200 millions divided by 2,000. That means that the company has 100,000 shares. But remember, during the year, it has issued an extra of 40,000 shares. So this company has 140,000 shares in issue. So what you do, you get the 200 millions, that is share capital. Of course, I will divide this by 2,000. This will give me 100,000 shares. These are opening balance, in brackets the shares. Then I have to add the issues. During the year, they issued out 40,000 shares. So in total, the company has 140,000 shares. But they have told us that they are paying shillings 210 per what? Per share. So the dividend per share times per share, that is shillings 210. You multiply. So 140,000 shares times 210, that gives us shillings 29.4. That is 29.4. Those were the dividends which we have to take to the statement of changes in equity. So dividends paid. that is note 3. We have seen a payment of how much? A payment of 29 millions 400,000. It's a minus 29.4. It's a minus. Total, it will be 29.4, the minus. Now the other item which you may find is all about the revaluation of non-current assets. We have to find out and see if assets were revalued, because whenever assets are revalued, there is likely to be a gain or loss on revaluation. There is likely to be a gain or loss on revaluation. So let us try to find out what happened. 30th November 2014, land and buildings were revalued as follows. Land 100 millions, then the buildings 295 millions. Non-current assets are depreciated at 2.5% per annum on reducing balance method. So the land and buildings were revalued. Land 100 millions, then the buildings 295 millions. We have been told that the non-current assets are depreciated at 2.5 per annum on the reducing balance. So we have to find out if there is a revaluation loss or a gain, but this is likely to be a revaluation gain. So this will be my next note. This will be note 4. So this will be note 4. Note 4. This will be note 4. Let us look at the revaluation of the land and buildings. Then we see the results of the revaluation. So note 4. Revaluation of the land and buildings. Revaluation of the land and buildings. We have land. The initial value of the land was how much? The initial value of the land, as per the trial balance, land had a value of 80 millions. So land, its initial value was 80 millions. Then the buildings, their cost initially was how much? That is 300,000. We assumed it was 300,000. Whether cost or carrying amount, we don't know. But I'll minus the depreciation. Because we have been told that the land depreciates by what percentage? By 2.5 per annum. 2.5% times how much? Times our 300,000, that is 7,500. So 300 minus 7,500, that gives us 292 millions 500. Now the carrying amount of the land, and buildings combined, that is 372 millions 500,000. But of course we have a revalued amount for the two combined. Land was revalued to 100 millions, then the buildings 295, that is 395 millions. 395. I've got the 100M plus the 295 for that. So you see we have a revaluation surplus here. We have a revaluation surplus of how much? How much is our revaluation surplus? This is 395. That is a surplus of 22,500,000. According to IAS 16, this revaluation surplus is accumulated in equity in the column of revaluation reserves. So we have revaluation surplus. That was note 4, valuation surplus. How much is our revaluation surplus? That is 22,500. That's what we have come up with as a result of revaluation. So when assets are revalued, the revaluation reserves increase. Then don't forget that the debit entry will be made in your property, plant and equipment. You will increase the value of land and buildings at by 22,500, 22,500,000. So those are the most common items. Those are the common items when it comes to the statement of changes in equity. We have the opening balances. We have our issue of shares during the year. We have the dividends proposed. I think since they were declared, we can show this as proposed dividends. We have the revaluation surplus. I think that's it all. Now what you have to do is to come up with your closing balance. Closing balance as at 30th November 2014. Let us come up with the closing balances. Just add my 200 plus this, get that. Here we add this plus the premium during there, 10, so you get 10. General reserves, the opening balance of 80 plus the transfer 2, that is 82. Then your revaluation reserves plus the surplus during the year. Then on the retained earnings, you have the opening loss plus the profit for the year, the transfer, and then this giving us that. Then the total, that is the sum of all these, giving you 473,600,000. These are your closing balances as at the end of the year. Those are your closing balances. So that is our statement of changes in equity. That is our statement of changes in. That is our statement of changes in equity, as you can see. Statement of changes in equity. So if you have your questions, you can share them in the comment section. In case you have something you're asking about the statement of changes in equity, feel free to ask that in the comment section. I'll answer that immediately. Don't forget to share this video to your friends. As long as you believe that it will help them, then please share it. Don't forget to subscribe. Don't forget to share. Don't forget to like. I remain your tutor, Senior Hannington. Thank you for watching. Bye-bye.